Welcome to today's Explainer. We're diving into a market tape that totally shrugged off a soft morning open to close solidly in the green, driven almost entirely by a massive Q1 earnings deluge. You know, if you were watching the opening prints today, July 30th, 2026, you probably expected a sluggish session. But the market definitely had other plans, and the data we're about to unpack shows exactly why. Sure, bargain hunters stepped in early on to scoop up some value, but what actually fueled the fire in this trading session? Was it just technical support or a fundamental engine driving the recovery? Well, as you'll see, the answer really lies in the sheer volume and surprise factor of today's corporate scorecards. Looking at the top line, the macro tape was incredibly resilient today. We extended the prior day's risk-on move, with the Nifty pushing up 0.28% to close at 24,317.15, and the Sensex gaining 0.35% to settle at 77,928.15. And this wasn't just some broad, formless rally. It was a targeted, sector-specific bid led heavily by IT, autos, and a noticeably firming oil and gas sector, all while the India VIX stayed remarkably subdued. Section 1. The Earnings Deluge, Blockbusters and Busts. Let's get right into the biggest Q1 results cluster of the season. This completely illustrates the divide we saw today. On one hand, you've got Vedanta delivering an absolute blockbuster. We are talking about a massive 205% year-over-year surge in profit after tax, hitting 6,597 crore with revenue up 46%. This is their first post-demerger Q1, and it firmly underpins the entire metals complex. But on the flip side, look at Hyundai. Their PAT cratered 35% to 889 crore due to severe margin pressure and a softer domestic passenger vehicle mix. It is a stark cautionary tale proving you just can't always cruise on autopilot, even if you're a top-tier name. Now here's where it gets really interesting. SWIGGY. Normally, a company posting a net loss doesn't exactly trigger a rally, right? But context is everything on Wall Street. The market actively rewarded SWIGGY today because they successfully narrowed their Q1 consolidated net loss by an impressive 34%, bringing it down to 791 crore compared to over 1,100 crore a year ago. The long thesis is playing out beautifully in the numbers right now. This narrowed burn rate was driven by a 37% jump in revenue to roughly 6,812 crore and a massive 40% growth in Instamart's gross order value. The market absolutely loved the trajectory, pushing the stock up a solid 3% by the bell. It is just a textbook example of investors happily paying up for a clear path to profitability. Moving right along to Section 2, Momentum Movers, two-wheelers shift into overdrive. Let's look at how this data fired up the auto sector. The crucial takeaway here is that the two-wheeler pack is running incredibly hard. HEROMOTOCO jumped 3.4% and TVSMOTOR added 3.3%, riding high on GST 2.0 rate cut optimism and strong festive demand expectations. But looking at the broader auto ancillary space, SONACOMS completely stole the show. They topped the futures and options gainers entirely, surging 6% to hit a fresh 52-week high. Because listen, SONACOMS isn't just riding blind momentum. It is backed by a spectacular Q1 print. They posted a 52 to 54% year-over-year revenue jump, and their battery electric vehicle mix hit a record 44% of auto sales. With heavy, delivery-based volume accumulation, we're seeing this transform from a simple auto play into a serious EV compounding story. And adding a little speculative fuel to the fire in the auto space, scuttlebutt on the dealer desks today suggests a potential GST 2.0 rate cut could be extended to motorcycles over 350cc. Now, to be absolutely clear, this remains entirely unconfirmed policy chatter. No official GST Council agenda item yet. But if it turns out to be true, it would massively benefit players like Eicher Motors. Section 3, the bear case, KPIT's hard landing, because, well, it wasn't all green screens and record highs today. So what exactly caused KPI Technologies to drop a brutal 7.7% today? I mean, this wasn't just a gentle pullback. We saw severe distribution and incredibly high trading volumes as institutions just rushed for the exits. A surprisingly soft Q1 triggered this brutal, coordinated wave of broker downgrades, and the consensus essentially cratered in real time. Axis Capital and Ambit both downgraded to sell, with targets in the 470 to 480 range. ICICI Securities slashed their target, and JP Morgan went underweight at 550. When four major desks turn on a stock simultaneously on heavy volume, it gets ugly fast. Somebody definitely needs to check on the KPIT options traders today.
Joining KPIT in the red were a few other notable names. Colgate-Palmolive dropped 3.8%. It's funny because they actually reported a 7% PAT bump and 12% revenue growth, but it clearly disappointed a market that was priced for absolute perfection. Alongside that, we saw some healthy but sharp profit-taking in realty and solar, with Prestige Estates dropping 4.7% and Warri Energies shedding 4.1%, and Premier Energies extended its post-results slide down 5.2%.
Section 4. Tomorrow's Trading Playbook. We've mapped out today's action, but what should we be watching for in the next session?
For the options writers and premium sellers out there, the August series rollover is now setting the tone. Our open interest data shows the Nifty Max Pain sitting cleanly at 24,200, with heavy call resistance up at 25,000. Meanwhile, Bank Nifty is pegged to a Max Pain magnet of around 57,600. Aligning your index option strikes to these printed magnets is going to be absolutely crucial as we navigate the start of this August series. And brace yourselves, because the earnings deluge is far from over. We have massive, index-moving event risk dropping in the next 48 hours. Just look at tomorrow's lineup for July 31st. MARUTI, which is hyper-relevant after Hyundai's miss today, alongside SUNPHARMA, ITC, IOC, and BAJAJFINSV. We are practically walking into a minefield of potential volatility. Also, zooming out from the micro for a second, keep a close eye on the macro tape. The August 1st U.S. reciprocal tariff deadline is looming right around the corner. Depending on the rhetoric and the actual policy prints out of Washington, this could act as a major swing factor specifically for our IT and pharma sectors, so keep your stops tight if you've got exposure there. If you want to navigate these massive swings without flying blind, you need the data first. So hit that subscribe button and ring the bell icon right now, because as we clearly saw today, being late to the news in this market is exactly like buying KPTI at the open. It will cost you. Let's stay ahead of the curve together. I'll leave you with this final, critical thought before tomorrow's bell. As the Nifty pushes toward fresh highs amid this wild, unpredictable earnings deluge, take a hard look at your exposure. Is your portfolio truly positioned for the breakout, or are you unwittingly walking straight into a valuation trap? As always, remember that this explainer is strictly personal research presented for educational purposes only. It is not financial advice. Markets are incredibly volatile, so always do your own homework and consult a professional before taking any trades. Thanks so much for watching, and we'll see you for tomorrow's wrap.